interpretation is that all of this is part of a much larger bear market or corrective pattern structure. In all of the examples I've used so far, and in the examples you're going to see for the rest of today and tomorrow, none of the rules are broken. What should you do as an Elliott wave analyst who is keeping real-time track of a market if a rule does appear to be broken? Well, there are only three, so this is pretty easy to deal with. If wave 2, what you're counting as wave 2, makes a new low, it's not wave 2. It's something that's part of the preceding corrective pattern. The only other two rules are that wave 3 should not be the shortest and that wave 4 should not overlap wave 1. Now, just for convenience, I drew a chart, a developing price pattern, which would suggest that both of these rules have been broken. And I can't tell you the number of times I have seen analysts in print or otherwise say, well, look, this is clearly 5 up, even though there's overlap and a third's too short, you got to sell this market short. But all they're doing is selling themselves and their accounts and the wave principle short, because the wave principle says this is not a 5-wave structure according to the rules and guidelines of the wave principle. What should you do when you see this kind of development? How should you think? If you have taken a very close look at the wave structures and the real-time charts that we've been looking at so far, you will see that in almost every case, the resolution of this kind of early beginning is the same. Don't label this first wave, second wave, third wave, fourth wave, because wave 4 has overlapped wave 1. That 4 is not allowed. Even if wave 4 had not overlapped wave 1, suppose wave 5 were developing, at what point could you not label that wave 4 and 5 anymore? As soon as wave 5 is longer than 3, because wave 1 is already longer than 3, and that will make wave 3 the shortest. That count is wrong then on 2 major points. What is happening in almost every case is that in truth, this is a developing third wave extension. Remember, third waves are usually the longest in a sequence. Therefore, they tend to subdivide 1, 2, 3, 4, 5 very clearly before they are over. And the ultimate correct labeling turns out to be that. In other words, someone had labeled this 1, 2, 3, 4, and they were trying to get a 5 out of here, already having broken one rule when wave 4 overlapped, and then another rule when wave 5 got too long. What is the practical result of breaking those rules, of putting one's opinion before the wave structure? Well, what's this guy doing right here? He's selling short. He thinks the market's going to go down and correct from here. What is it actually setting up to do? Right in here, there's probably a 2-day pullback that convinces him the high is in. But actually, the market is right on the threshold of the third wave, the most powerful upward section of this entire advance. Just when he should be the most bullish, he's turning bearish because he got lazy or dishonest and didn't follow the rules. There are only 3 of them, and they're easy to follow if you keep them in mind. So the right thing to do is label this as a smaller 1 and 2 of a developing third wave extension pattern. That one little picture should keep you out of trouble of mislabeling waves virtually all the time. Now, for our upcoming exercise in wave counting, we must be sure to understand the primary concept of the wave principle. The one major discovery that R.N. Elliott made that change the way people will be looking at stock charts forever. And that is that the market moves in 5 waves, according to the rules and guidelines we've discussed, when moving in the direction of the one larger degree, and in 3 waves, or some corrective pattern, which is based on the 3-wave theme, when moving against the trend of one larger degree. If this is a large 5-wave upward structure, then this wave, wave 1, is moving in the direction of the one larger trend and therefore subdivides into 5 waves. This movement, which is wave 2, is moving against the trend and therefore it will subdivide into 3 waves. This holds true right up through wave 3, 5 waves, 3 waves on the pullback, 5 waves up. Now, you see right here, for instance, a wave 4 taking the 3-wave shape. This is a blow-up of that correction. My question to you is, if this is an ABC correction, which is moving downward right here, how many waves should wave A subdivide into? Sometimes I hear 5 and sometimes I hear 3. At least nobody said 4. The answer is wave A subdivides into 5 waves. The reason is that wave A is moving in the direction of the one larger trend. This one larger trend's direction is down. The correction is a counter-trend movement. We were talking about a bull market, therefore the counter-trend movement is down. Wave A is moving in the direction of the one larger trend, which is also down. It will subdivide into 5 waves. It is incorrect to express the wave principle as 5 waves up and 3 waves down because the direction per se doesn't matter. What matters is what the direction of the one larger trend is. Then the movements of one smaller degree will subdivide into 5 waves when moving in that direction and 3 against. How many waves should wave B subdivide into? This now, you see, is the counter-trend movement. Wave B is the correction of a declining sequence. Wave B is moving against the trend. So it subdivides into 3 waves, or some kind of corrective pattern which is based on the 3-wave theme. Wave C, of course, is moving in the direction of the one larger trend, which is down, and therefore will subdivide into 5 waves. That one concept is going to keep you in tune with markets when you open a chart book and say which direction are the 5s moving in and which direction are the 3s moving in. That in itself will give you a lot of information. Another reason I brought this up now is that we're going to come back and we're going to walk through the wave structure of a bear market. So you have to understand how the wave structure will develop in the downward direction, which is exactly the same as the way it develops in the upward direction. Let's take one glance at a bear market picture, which we all know and love. That of U.S. Treasury bonds from the 1940s. Well, this market traced out 5 downward waves from the 1940s right into the 1981 low in bond prices, which of course was the high in interest rates, since they're the inversion of each other. Well, let's take a look at some of these things. Is wave 3 the longest? Yes. Wave 1 is rather short. Wave 5 is certainly much shorter than wave 3. Let's take a look at where a counter-trend movement would likely end if we've had 5 waves down. Well, where should it end? We're having a correction now, but in this case it's pointing up instead of down. The guideline still holds. It should end in the area of the 4th wave of the preceding impulse, which is why this little 4th wave area, in my opinion, for the past several years, has stood as resistance to this corrective counter-trend rally. The long bond in approximately the 7 to 7.5% area was resistance for this super bond rally that we had from 1981 to 1986. Now, you may have heard commentary to the effect that that bull market was the best bull market in the history of the United States bonds. You know what? It's true. And that's pretty sad. This is the classic and typical direction of bond prices over the years. Someone somewhat feistier than I once referred to bonds as certificates of guaranteed confiscation. Now, whether that's true or not is beside the point, but they don't make great long-term investments. They make great trades upon occasion. I would say that as long as this resistance area is not penetrated significantly on the upside, this picture should be viewed as long-term bearish. The five-wave structure has defined the major trend, the one larger trend, as down. The ABC structure of the rally has defined that as the counter-trend direction. So it tells you that on the very long term, the trend of bonds is down, the trend of interest rates is up. If you have trouble visually adjusting to the idea that we can have 5 down and 3 up, just do this. You see, it's the same structure. You get 5 in the direction of the one larger trend and 3 against, and of course this is not bond prices anymore, this is long-term interest rates. We've had a bull market in interest rates peaking in 81. We had a bear market that probably ended in 1986. It could make another low in this resistance area. We didn't penetrate it. But nevertheless, we have done all we had to do to correct that great 5-wave upward move lasting almost 40 years in interest rates. I'm often asked how these structures can continue to develop over the very long term. People say, look, Bob, you're telling me that the 1980s bull market in stocks is somehow related to this bull market of the 1930s. When all of the people who were participating in the market back then, or most of them certainly, have long since passed away. Certainly, even if they're around now, they're not trading like they were back then. How can you tell me that something that these speculators did back 50 years ago has anything whatsoever to do with what's going on in the 1980s? Well, let's forget the empirical side of it first. Elliott's observation that they do, and therefore you've got to deal with that rather than just trying to deny the fact that it happens, and try to figure out why events that occurred years or decades or perhaps even centuries ago have anything to do with what's going on today. Well, I used to try to give an explanation that referred to the way cultural values are transmitted over a period of time, but I never could formulate an answer as eloquently as a sports writer could. So I'm going to read a few paragraphs from one of the great sports writers and see if we can get some insight into the answer to this question from his observations on the aftermath of a football game. This happened to be an article that came out in November of 1984 describing what happened after the Florida Gators won the Southeastern Conference Football Championship for the first time in the history of that university. Now, for the moment, we won't discuss all the ramifications of what developed afterwards. Just suffice it to understand that for 50 years, this football team, or let's say this university, had participated in the Southeast Conference, the SEC, and had never once won the title. And this year they did. And here's how it was described. And when the scoreboard clock struck 0, 5 decades of frustration burst into 5 minutes of glorious joy. Gerald Wilkins, a reserve linebacker, sprinted to midfield, flung himself to the turf, and writhed in ecstasy. Elaine Hall, the coach's wife, leaped to kiss Lomas Brown, the offensive tackle, on the cheek. On the chilled sideline, Alonzo Johnson bent at the waist,